Good afternoon, everybody. I'm so happy to be here. My name is Kara Kennedy. I'm with ClearTrust. We're a stock transfer agent. We serve growth companies and community banks. And a very common topic of conversation amongst our issuers is uplisting. Companies go public a lot of times. Smaller companies will start on OTC markets, and they all have this dream of one day being exchange listed. But a lot of questions come with that. Should we uplist or not? To what exchange should we go? What's the process? What does it take? How much does it cost? Is this really the right thing right now for our company? So many questions. Very good questions are wrapped into this, and that's why we've assembled this panel today. So I'm really excited for you to meet them. These are some of the leading experts in this field. And without further ado, I would just like you to go down the line, and if you could just very briefly introduce yourselves, starting with my good friend Dave.
Sure. I'm Dave Donahoe, and I run a consulting firm called Donohoe Advisery. We work with companies on all things listing related. We help companies structure acquisition and financing transactions. We help companies that are listed that have fallen below the listing requirements put together business and compliance plans to keep their listing. And more than anything else these days, we're working with companies on uplistings. So we're probably working with about 20 companies right now that are at various stages within the process of uplisting both NASDAQ and the New York Stock Exchange. There are 4 principals at my firm. 3 of us came out of NASDAQ. I was chief counsel in the listing qualifications group at NASDAQ, and 1 came out of the New York Stock Exchange.
Hi, my name's Robert Haag, and I'm managing director of IRth Communications, IRth Communications. We have about 18 listed companies. Listed, I mean trading publicly, half of which are listed on NASDAQ or the NYSE MKT, and the other half are OTC. As I mentioned before, we've helped 6 companies uplist, 3 of them this year alone. And we find that actually having efficient and effective shareholder communications and outreach is extremely important to uplisting, especially when companies have undergone reverse splits or need to meet minimum $3, $4, bid requirements, et cetera, et cetera. And we do a lot of heavy lifting and outreach. We have 10 full-time telephone outreach specialists and take companies on road shows and look to dig up, the uncovered diamonds in the rough that are out there in the investment community by reaching out to brokers, registered investment advisors, and funds on a regular basis. So, next.
Thank you. Jason Paltrowitz, Executive Vice President and Head of Corporate Services for OTC Markets Group. Those of you might think we would not be pro-uplisting, but that couldn't be further from the truth. We operate, as you know, 3 marketplaces serving over 10,000 U.S. companies in various stages of their development. Our top 2 markets, OTCQB, of which some of the companies here are, and OTCQX. We take a lot of pride for those companies that are going through that, that long road to uplisting of being the market that companies need now. So working with companies to make sure that when they do take that jump, they actually are ready. And there are a lot of things that companies don't actually think about. They just see that NASDAQ banner and look there. Since 2012, we've graduated over 400 companies. Last year, we graduated 83. To date this year, we're up to 50. We take great pride in that. We actually press release every company that graduates and congratulates them on being part of that journey. But it is imperative that companies are ready, and there are a lot of things that companies should be doing. Otherwise, when you do make that jump, you'll find yourself kind of flailing along a little bit and not seeing the success you wanted.
Good afternoon, good morning, I guess it's morning. I'm David Feldman. I'm a partner at the 700-lawyer global law firm of Duane in their New York office. I practice corporate and securities laws. I take companies public. We uplist them. We do all types of financings. I've written 3 books on finance and entrepreneurship, including the only text on reverse mergers that's out there, so we're going to have a chance to spend a few minutes rebutting some of the prior comments that were made. I'm a Wharton grad and the former chair of Wharton's Worldwide Alumni. I'm an entrepreneur myself, having bought and sold a number of businesses, and I apologize in advance because due to this time shift, I've got to zip out for a noon conference call, so I will leave before this ends, and I apologize in advance for that.
Very good. All right. So why would a company choose to uplist rather than trade over the counter?
I
I'm
can
not-
speak to that.
Okay, go
No,
ahead.
go ahead.
We all can.
We all can, yeah. Go ahead. No.
Well, I think there are a number of reasons to uplist. First, it's gotten more difficult to raise money in the over-the-counter markets in the last few years. And most of the companies that we talk to, are the types of companies that need to continue to raise money to advance their growth. The liquidity on the exchanges is also a little bit better than what you see in the over-the-counter market. You don't have as much access to retail investors or even to many institutional investors when you're over-the-counter. One of the best ways to move up to an exchange is to do an offering concurrent with the uplist. By doing that, you're going to help increase your liquidity. You're often able to get research coverage from the firm or firms that are assisting you with that offering in the uplisting, and it gives investors a reason to care about the company. It's basically like a re-IPO for the company when you do the offering concurrent with the uplisting.
Yeah, I would pretty much say the same things, but it's, there's a lot of prestige involved with being listed on NASDAQ and the NYSE, and you open up a whole host of potential shareholders, investors that either don't want to transact in OTC companies or are more interested in transacting in listed companies. And so your access to capital is usually cheaper and faster. And then also you're blue skied in every state automatically, which means that brokers can now buy your shares for their clients if they want to, without going through the arduous blue sky process.
Yeah, one of the big things on the access to capital, which is within the last, I guess, 5-6 years, is that when you're in the over-the-counter market, if your market value of publicly held shares is less than $75 million, you're not eligible to use an S3 shelf registration statement. So you can't do confidentially marketed public offerings. But when you're listed on an exchange, you can. Now, if you're less than $75 million in market value of publicly held shares, they have the baby shelf rule. So you can sell up to a third of your public float in any 12-month period. And that's a big deal because most of the deals that you see today are registered deals. Probably the large majority are confidentially marketed public offerings or at least registered direct transactions, and that's a real advantage.
There has been some congressional action on that we've been working with the House Financial Services Committee, which actually did pass a bill that would allow all reporting companies, regardless of market value, to use S3 and actually eliminate the baby shelf rule for NASDAQ companies. We don't know where that's going to go, but you're right, that's definitely been an impediment to capital formation for these smaller companies.
I would also just take a little bit of the counterpoint. The SEC did a study that for companies in the $50 to $100 million range, 80% of those shareholders are individual shareholders. And so there's a market infrastructure difference between the OTC markets and New York and NASDAQ, primarily being the national exchanges run limit order match engines, whereas we run what NASDAQ used to be, right, before it was an exchange, which is a broker-dealer network connecting individuals that can buy and sell securities. If you are a small company, knowing that primarily your shareholders are retail, knowing that you do not yet have that liquidity, a limit order matching engine becomes kind of a dysfunctional operation for you. It's very hard to get that liquidity until you get to a certain point where then it makes sense. And so those market structure differences are very real, and we find a lot of companies that haven't gone through that process of building their liquidity, organically through using IR firms and getting out and telling their story and, going to investor conferences and getting that bit of liquidity. When they go too soon, the infrastructure isn't there to support it. And so you really do have to make sure that you've done that legwork in advance. We have many number of companies that come back to us and say, what happened? We thought we were going to see that bump, and that didn't. Certainly a liquidity event helps, but barring not doing a liquidity event like that, it is something to consider.
And you know, there's an interesting advantage from our perspective as a transfer agent to uplisting. Every single one of our clients asks us about going DWAC eligible, and all of their investors want that as well. If you're not familiar with that, it's a means by which your shares can be deposited electronically into a brokerage account. DTC approves of companies on a case-by-case basis for DWAC. We've been very successful in ensuring that our clients are made DWAC eligible, but the only way to guarantee that a company will become DWAC eligible is to uplist. If you're trading over the counter, you will be subject to a DTC review. So it's not as important as raising money and liquidity and all these other things, but it is a common pain point for issuers. So anyways, what listing standards must be met if you do decide to uplist, briefly?
Well, at the exchanges, at both exchanges, they have multiple listing standards. So at NASDAQ, on the NASDAQ capital market, they have 3 separate standards, one which is based on your net income from continuing operations, one which is based on your market capitalization, and one which is based on having a certain amount of stockholders' equity. It really, that's on the lower tier. Then they've got 4 sets on the NASDAQ global market, and they've got multiple sets on the global select. You don't see too many companies that uplist onto the global select market, but most go onto the NASDAQ capital market. But they have a similar structure at the New York Stock Exchange, where they've got multiple tiers, again, income, market cap, and stockholders' equity. The one difference between the exchanges is at the NYSE MKT, which is the lower tier, and that's where almost all of the uplistings go when they go to the New York Stock Exchange. You can get on with a market cap and a $2 stock price. You need a market cap of $50 million. But for the other issuers, they can come on with a $3 price. NASDAQ has adopted within the last few years a $2 and $3 price requirement in addition to their main price requirement, which is $4. But there are certain additional criteria that you have to meet to use the $2 or $3 standard. So you see very few companies that actually are able to go to NASDAQ under the $2 standard.
And do they ever make exceptions to their listing standards?
No, the exchanges will not make exceptions to the listing requirements. Back in the 1990s, they did it all the time, and I was there at the time. And basically, we sat down and we looked at where we'd been making exceptions. We revised the initial listing requirements, and we said, look, we're going to make them more flexible, but we won't grant exceptions anymore. And NASDAQ has been repping to the SEC since the late 1990s that they won't make exceptions. And the NYSE MKT, continued to make exceptions for a period of time, and then they ran into a problem with the SEC based on some of the exceptions that they were making, and they no longer make them. So.
But they've tried to offer multiple ways to get there, so that it's not
right.
stuck in one.
They've done the same thing. They've got more flexibility, with the different tiers of listing standards. But if you're short on price, they're not going to give it to you. If you're short on equity, they're not going to give it to you. So the other thing too is, for most companies that are going to uplist, they're not making money, and so there's a big discretionary component in the uplisting process, and one of the aspects of that is they're going to look to see, okay, if you can meet our initial listing requirement, how long can you continue to meet the requirements after you list? So, for example, if the listing requirement is $5 million in stockholders' equity and you're losing, $1 million a month, they're not, even though you have the $5 million, they're not going to want to list you. The other thing too is they're going to look at your cash, and cash is not a listing standard, but they want to make sure that you have cash to operate, usually for at least a year. If you have a going concern opinion in your last audit, they're definitely going to want to make sure that you can make it for a year. If you don't have a going concern opinion, there may be a little more flexibility, but they are not in the business of listing companies only to initiate delisting proceedings 9 months later.
Absolutely. And what about timing? When would you say it makes sense to uplist?
In our opinion, it makes sense to uplist when a company qualifies. They're just going to expand their, potential, their access to capital, to investors, and why wouldn't they want a broader reach? So to delay that, they're really harming their shareholders, their ability to raise capital. So, the sooner the better.
Yeah. Almost every company that we work with does not meet all of the listing requirements at the time that we are filing the application to start the process. But you always have a plan to meet them. And when we submit the application, we provide a cover letter, and we explain what that plan is. Most of the companies have to do reverse stock splits to qualify, and many other companies are also raising money concurrent with the uplisting, and so those are usually the core components of the plan. What NASDAQ will say on their website is that you can get through the listing process in 5 to 6 weeks, which is true if you are a Goldman Sachs IPO, but it is not true if you're an over-the-counter company. And particularly right now, they've got a tremendous backlog of listing applications because the market had been so good up until very recently. And so, it's taking, much longer to get companies, through the process. If a bigger company can still go a little bit faster, so we listed a company on Monday, and they had over a $500 million market cap, and they were probably in the process for only about 7 or 8 weeks, but many others are in for much longer.
And I think it's important to note that just meeting the financial criteria is not enough. The exchanges have wide discretion to say, you may meet the criteria, but we just don't like you for some reason. And you want to come with kind of the 5 key characteristics of a great story, a great management team, a strong capital base, a strong and wide shareholder base, and great advisory team around you, including strong and reputable IR guys who are going to help you really build market support for your stock.
Yeah, I'd say you only really do it once, and so you want to be there doing it right and being well prepared. We actually looked at 47 companies that uplisted last year. 23 of them did a reverse split to do it, and their price since doing that is actually down 22% versus the companies that didn't do a reverse split to get there. Those companies are actually up 7% on their price. Now, granted, we're in an interesting market time, but still, all things being equal, you do only do it once. And so, a little more time to prepare and be ready for it is not necessarily a bad thing in the long run.
It's not automatic that when you uplist, everything is rosy. I mean, you've got to make sure that you've got a comprehensive approach to the uplisting. So you need a quality IR firm to help you. You need to get out there. You need to tell your story. You need to get into conferences. You want to make sure that you're approaching the gold standard on your corporate governance. It's not good enough just to go ahead and try to check all the boxes that the exchanges require. We're working with a company right now. They just listed a year ago, and they've run into a problem. And we started going back to look at what they've been doing over the last year. They were not doing their board minutes correctly. They were not having the board approve the minutes at the beginning of each meeting. They were public, but they didn't do all the other things that you need to do to be a quality public company. And the institutions, when they're making a decision as to whether they're going to get involved, they look at that stuff. And that's the quality corporate governance program is very important to them. So you have to do it all.
I would concur, and that is true not just if you're considering uplisting, but if you're an OTC markets company, you should have strong corporate governance. You'll find that DTC is more likely to make you DWAC eligible. Brokers are more likely to accept your stock for deposit. Funds are more likely to fund. I mean, corporate governance goes so far. And then if you already have a strong corporate governance program, when you go to uplist, it's not some radical change. You're already doing things the right way. So I would certainly agree with that. Switching gears slightly, though, I want to talk about reverse merger seasoning rules. It seems to be maybe there is some confusion about that. So could you clarify what are the reverse merger seasoning rules, and are there exceptions?
The reason it's confusing is because it's confusing. And after a whole bunch of Chinese companies that did reverse mergers turned out to be frauds, although a number of Chinese companies that did straight IPOs turned out to be fraud. So I would argue it has nothing to do with the method by which they went public, but the SEC felt they had to do something. So they kind of forced, quote unquote, the exchanges, who technically did it on their initiative, to say, we're going to require that if you do a reverse merger with an SEC reporting shell company, you have to trade over the counter for at least one complete fiscal year before you can even apply to uplist. That's the basic rule. However, there's an exception that if you can raise a 40 million plus public underwritten firm commitment underwritten public offering, you can bypass the speed bump. There are other techniques we've developed that we're not allowed to talk about right now in public, but they're legit and they're allowed. Unfortunately, this has caused a number of people to say, forget it, I don't want to do reverse merger. We are still doing reverses for some biotech companies and others that actually say, I like the idea of having a year or so of trading over the counter, getting used to being public, developing my corporate governance, but still being able to raise money while I do. Or if they need to raise money very quickly, and the source of financing says the only way I can do this is if you're already public. So the seasoning rules have made it difficult. A lot of the SPACs got caught in the middle of this when they were trading over the counter. We are trying to get the SEC to consider changing this rule. I don't know if that'll happen, but because there are some loopholes in it that they realize they don't like, and that might be the way to get them to change it. But it was not a happy day for me.
There's a misunderstanding, too, as to how the seasoning requirements work. So many people think, well, if I'll do the merger and then I just wait 1 year and then I'm eligible to go up. But it's actually, you've got to go 1 year on a combined basis. So if you've got a company that has a fiscal year end that's December 31 and they do a reverse merger on January 15th, they've got to go all the way around to December 31 of the next year, and then all the way around to December 31 again, and then file their 10K before they've met the requirement. So that's a long period of time. The other thing too is, well, I think initially it was intended that this rule only apply to mergers with true shells in the over-the-counter market. That's not how the exchanges are applying it. So they're basically looking at the transactions and saying, if the sum and substance of this transaction is that they really did this just to go public, it doesn't matter whether the other company was a shell or not. So, for example, if you spin off the other operations for the public company at the time that you do the deal, they're going to call that a reverse merger transaction. So if you're doing a deal like that, hold on to those operations, spin them off later. And it doesn't matter if the SEC doesn't require you to file a Super 8K for the transaction because they don't deem the public company to be a shell. The exchanges are going to look at it and they're going to make their own determination as to whether they think that they should apply their reverse merger rule.
And in fact, the seasoning rule says that the exchange has the right to deem a company the equivalent of a shell, even if it has some operations, if they think the operations are so minimal that they're effectively a shell. You're correct. But we have gotten some companies to change their fiscal year and get around the other issue, which is you don't have to wait 2 years if you choose to change your fiscal year.
Yeah, you can do that. Initially, they were not crazy about that, but they came around, and the exchanges will let you change your fiscal year to address that.
And what about a reasonable time period? So you said 6 weeks isn't necessarily reasonable for an OTC company. What is start to finish to uplist?
I mean, I think it really depends. It depends on a number of things. But one of the primary drivers is how many other companies are in the application process at the same time that you're going in. It also depends on how many moving parts you have. If you have a lot of actions that you need to take to meet the requirements, the exchange is not going to move as quickly in getting you through the process as they might otherwise. So with the one that we just listed on Monday, we had some stuff that was going to be happening in the near future, and we told the exchange about that, and they actually went faster to accommodate us so we could be listed, if and when those things came to pass. But you can. I think if you're going in the process, if you went and you looked at what the average time is in the process right now for companies, I would say it's probably over 12 weeks that they're in the process. And there are some that have been in there for much longer. But put it this way, about a year or two ago, NASDAQ adopted a rule that says if you're in the application process for more than a year, they're going to hit you up with another $5,000 application fee. They wouldn't have adopted a rule like that if companies never were in the process for more than a year. So.
If you're in the process for more than a year, you should probably just give it up.
You went too soon.
Sounds like a revenue generator.
They are public and they are for profit themselves. So.
And speaking of revenue, does it make sense to do an offering concurrent with an uplisting? Yes, I'm seeing a lot of yeses. Costs a lot of money, so yes.
That's the most common way that people do uplist because it enhances the capital, it enhances the shareholder base, it enhances the opportunity to develop strong support for trading.
Yeah.
And what about engaging an IR firm? When should a company do that?
I guess that's me.
Yeah.
You know, a lot of companies don't value IR because they sort of feel that it's an expense that they don't need to make. That if their business just works out, then investors will come. But there are thousands and thousands of small companies out there, and especially when you're sub 250 million market cap, which most of the companies are that all of us are dealing with here. They're nano caps, micro caps. You're one of thousands and thousands of trees in the forest. Which is the best tree? And no one's going to know about it unless someone's out there telling the story. And that's one of the things that we really focus on doing. And one of the reasons we're effective is because in addition to our standard fee, we actually employ marketing budgets. So stock is a product. Products need to be marketed. And while, like any product, like a pharmaceutical or something, it's a regulated product, so stocks are regulated, but they need to be marketed in a certain way, and there are a variety of ways to do that. But getting out there and telling your story is very important. Otherwise, you could have the best story in the world, and no one's going to know about it. And also, if you have limited trading volume or a market cap that's very low, your access to capital becomes much more expensive. So when to engage, an IR firm? Actually, even before you're public, we've helped companies go from being private to doing a reverse merger or even an APO. And we helped one company that for 6 months didn't really even have many shares available in the float because they're waiting for a registration statement to go effective. Yet 6 months of telephone outreach and a variety of road shows. Then when the registration statement went effective, instead of just having a whole lot of selling and no buying or potential buying, they actually wound up having a great audience, and the stock was undervalued, and it sort of supported itself through the outreach that we and some others had done. So it's almost never too early if you do it the right way and you do it with an effective IR firm.
It's important to use the right IR firm, though, too. There are a lot of guys out there that don't do it the right way. And we talked before about the discretionary aspect of the initial listing review. And one of the things that the exchanges do is they go out there and they look for mentions of the company, on the internet, and chat rooms and different places seeking alpha. And if they think that the company is engaged in overly promotional activities, that in and of itself can be a public interest concern that prevents that company from listing. They'll ask, please list all of your IR firms. How much have you paid them? What form did you pay them? They'll sometimes ask, what were they doing for you? And there have been a number of companies that have been turned away because they were not doing it the right way. But the IR firms, the ones that do it the right way are important because they can get you into conferences, and they need to get you out there, and they can help you put your IR out and get your message out.
I guess I'll reiterate, even on our QB and QX markets, we're looking at the promoters. We're doing the same thing the exchanges are doing. We'll take companies off or we'll halt. What we do is skull and crossbone it, and then we'll tell FINRA when somebody's being, overly promoting, and we'll kind of halt a company on our markets. And there are a lot of those guys, unfortunately. That IR is not a regulated business, so it is important to do the due diligence and to do it early. It's that vicious circle. If you want to be ready for the uplisting, there's a lot of work, not just in the forms and the paperwork, but in properly promoting your security. I used to do this internationally, right? There's 65,000 equities in the world, right? So how do you get to be noticed? And it's a lot of hard work for the company in being successful in executing its plan, but the help of an IR firm to get you to conferences, to get research written. We do a lot of that for our companies ourselves, as do NASDAQ and the exchanges, helping the companies get that visibility as well. So it is very important.
All right, and so far as budgeting goes, how much should a company budget to both get through the uplisting process and stay public exchange listed for a year? I think corporate governance, everything. What would they be looking at? And then I want to compare it to OTC markets fees.
Well, Yeah. So
We always win that battle.
Yeah, so the exchanges, obviously, they've got initial listing fees when you first come on, and it depends on how many shares you have issued and outstanding, so it's kind of a tiered structure. And then they have continued listing fees. And NASDAQ just came out with a new program, I guess about a year ago, where you can get kind of this all-inclusive fee. So the way it used to be is you had your continued listing fee, but then you had to pay, other fees throughout the year. Like when you did offerings, you have to pay listing of additional shares fees. If you did something like a reverse stock split during the year, they call that a substitution and listing event, and that's $15,000 for that. So now you can go ahead and you can pay a slightly higher annual fee, and you get all of those other services in there for free. You don't have to pay them each time that you do them. For smaller companies, in most instances, that's a good idea, because the smaller companies are going to be raising money all the time, and so they're going to be bringing up the listing of additional shares fees at least. But the annual fee right now, I think on the all-inclusive for the Capital Mart is something around $55,000. The highest one on the initial listing coming on is around $75,000 right now. And then you've got, obviously, if you're doing an offering concurrent with the uplisting, well, you've got your lawyer's fees for doing the registration statement, whether you're doing a registered deal concurrent with the uplisting, or whether you have to go out and register the shares because you did a pipe after the deal. So you've got that expense. You have the expenses of going through the listing process, itself. For us, we usually probably come in somewhere around $10,000 to $20,000 for a listing application. So we're actually one of the lower costs of the whole process. But that'll give you some sense as to what you're looking at. Of course, most companies that are doing uplistings, they already have PCAOB auditors, so they're already paying for the audit. But obviously, you have to continue to do that as well. And you're going to, many companies also, are required to go out to bring in, accounting consultants to make sure that their internal control environment is appropriate. And so you have expenses like that. Those are expenses that if you're an over-the-counter company, you might not care as much about that, and you might not deal with it. But when you're a listed company, you need to.
And then you also have to have a majority independent board, so you have to think about compensating your board. You also, I know a lot of OTC companies of ours like to skimp out on their annual meetings, but you do actually have to hold your annual meetings, so you're looking at $5,000 to $30,000 for that. So there are ongoing expenses, and with that in mind, how does this compare to the cost of trading on OTC markets if you were a QB or a QX?
So QB companies, straight listing fees, so we don't graduate fees based on number of shares. QB is a $2,500 application fee one time, $10,000 a year. QX is $5,000 application fee, $15,000 a year. QX has financial standards that companies need to meet, similar to NASDAQ's standards, but you can be listed on QX using IRth, so you don't need to necessarily be SEC reporting to be a QX company. You can qualify under the IRth standard. For QB and QX, also with Reg A+, we've got Reg A+ standards, so you can, in various way, shape, or form, if you're doing a Reg A+ deal, either get on with those standards on QB or QX. Into next year, as we continue to grow the market and certainly look at QX and making it more of a premium market, not announced yet, but we will be instituting some corporate governance standards as well for our QX companies, again, as we look to make that the premium over-the-counter market. Nowhere near what the exchanges will require, but so those expenses would be worked in there.
Very good, very good. And so obviously uplisting isn't right for every company. What are some reasons why an issuer would choose to trade over the counter? And what are some of the drawbacks of being uplisted?
So we service a lot of different company types. So those 10,000 securities, many of them are small cap, early stage developing venture companies. We also service a very large global footprint, so companies listed on our market, companies like Adidas and Heineken and Volkswagen, which is in the news, so not great. We have a marketplace for community banks, and we have a marketplace for Canadian dual listings, right? These are all different types of companies, so they all have different reasons for being there. Certainly the international companies, many of those companies are companies that were New York Stock Exchange listed or NASDAQ listed and chose to delist and deregister because of the costs associated with Sarbanes-Oxley. If you look at AXA, is one of AXA Financial, they came off New York and they said it was costing them $20 million a year to be duplicative in their reporting. That made no sense for them. In Canada, the same way. These are companies that are listed on the CSE or the TSX Venture. They're already reporting to their local market regulator. That cost of being duplicative in another market doesn't make sense for them. When you look at what we're talking about, that smaller, nano cap, small cap, these are companies that do have aspiration. Many of them have aspirations to be exchange listed, and we know that going in. Again, we like to say we're the company you need now. And this is what we're talking about. We're the marketplace you need now to get you to the place when you do make that jump, and we're happy to hear and help you support you make that jump, but you do it in the right way. And being public company is not easy. And there are many variables, and David gave you 5 key things to being successful, and we agree with that. And so it's a great place for companies to go to learn to be public companies. And if I were to look at the 1,000 companies we have on QB now, most of those are companies that are very much learning how to be public companies, learning what conferences to go to, learning what broker-dealers to talk to, learning how the trading environment works, how broker-dealers trade, what the compliance restrictions are against broker-dealer trading. And they have compliance restrictions on NASDAQ as well as OTC, and people don't necessarily understand that based on stock price and other things. And so learning that environment and that ecosystem and being ready for it is a good part of why companies choose to be OTC right now.
Very
Yeah,
good.
I mean, if you're a company that doesn't plan to raise money, in the future, or doesn't plan to make acquisitions, you may say that the cost of going to a listed exchange is more than what you're willing to pay. But if when you're listed, though, the cost is worth it for being able to raise the money, and you're going to have a different currency when you go out and you're looking to make acquisitions. You're also going to be able to attract higher caliber employees because they're interested in getting stock options, and they'd want to have stock options from a listed company. But if you're not doing any of those things, then maybe you don't have an incentive to go up.
Very good. Well, I want to thank you, gentlemen. You've been such a wealth of knowledge. Do we have time for Q&A, or are we over? I don't have a clock. So. Are we good?
Yeah.
All right. Very good. So a couple of questions, anybody, for our uplisting boot camp? They told you everything you ever wanted to know.
I've got a question for you guys. You mentioned a couple of things. I'm hearing a common theme here, and everybody in every panel has said something about not having good resources. In other words, be careful. Be careful. Take your time. I'm hearing that consistently. And it kind of comes along with the theme of what we talked about earlier, of trying to find those right resources. So my question is, from the IR side especially, we talked about, you used the word promotion, right? And I know that's a bad word in this industry, and being over-promoted and all of that. Is there a list somewhere? You mentioned having a skull and crossbones. Is there a place companies can go, a resource, to see, hey, where are some of these companies that aren't, you probably should stay away from? Is there anything out there, a resource for these companies?
Did everybody hear that?
Protect that.
So Delray posed a question with regards to quality team players. Are there any public resources that you can go to know, are they quality IR companies? Are they quality attorneys, et cetera? Where can we go for that? And I know you have an answer.
So, I mean, you can never police the world as much as we think we can try. We put a list on our website. So we have preferred providers. So those are ones we know meet the criteria that we put out there, or that have done good work for the companies with which we work. We also have a do not accept list. So we monitor that, and when a company does something that we think is egregious or illegal, and certainly we work with FINRA and the SEC on that, right? So when the SEC has a do not do business, we'll put that up there. It's not a full list. It's not something that I would gamble. Yeah, but we try to keep people as informed as possible. as to when we see something. You know, you guys might remember the CYNK sink was one of those big stories with the guy who lived in, I guess it was the Dominican Republic or Costa Rica, and for a brief moment in time, he was like the fourth richest man in the world. The stock went from a cent to $14, right? We were very much on top of that and figuring out who that was and working with the SEC and getting, you know, trying to make that as public as possible. Like, do not do business with these guys.
Yeah, I don't think the exchanges, though, have lists like that. So, I mean, really, the way you're getting to the service provider is through, you know, through referrals. So, I mean, the way we're set up as a consulting firm, and probably in, you know, more than half of all our engagements, we're actually brought in by the company's law firm, so to work to work with their clients. And you know, I'm obviously a lawyer, but my deal with the you know, with the law firms is that we're not going to do any SEC work. So we're not going to steal their client. We come in and we do the listing thing, and then and we move on. So
Part of our listing process is a LexisNexis search. So we do require companies to tell us if they are using an IR firm, who it is, who their auditors are, who their board of directors are, and then, you know, we run, our compliance team in DC will run those searches, and if there's a red flag, we'll.
That's one thing that they do very well at OTC Markets. So they've got a button on the quote page where you can just click a profile, and it's got all of the information on the company, law firms, accounting firms, how many shares are outstanding, what's registered, what's unregistered. It's amazing to me that the stock exchanges don't have something like that. But you have to go to the OTC Markets to get it. But it's very helpful and very easy to use. So.
Absolutely. Yes, sir.
Jason, what are you, over the last year and a half, I've noticed, trying to get a lot of the smaller cap stocks into accounts. The major firms are clamping down on that pretty hard. Anything they deem a penny stock, even if it's DTC eligible. What are you guys doing to work on that?
So the question is with regards to the difficulty in depositing stock certificates or stock, even electronically, into brokerage accounts. And so has OTC Markets made any progress?
So we're making a lot of, well, I won't say progress. It's on our agenda. There's a FINRA rule, was it
0905.
0905,
Yep.
right? So that's not just OTC securities, that's all securities. It's an issue, and it's one that we're working on. So a lot of our regulatory agenda really does circle around our QX market and our QB market, and making sure, you know, we're not what pink sheets used to be. We've come a long way since 2000, 2007. So trying to figure out ways with the regulators that we can get them more comfortable around that. You know, if you look at the companies we have on QX, these are companies, many of which, if not all of them, would be NASDAQ, if they wanted to be NASDAQ-eligible securities. So we spend a lot of time with FINRA. We will be raising our standards for QX next year. So we're working through that process of what do we do to raise those standards so that they meet the criteria. But, you know, we're faced with that issue. You know, our companies are. There are NASDAQ companies that are faced with that issue. It's a tough one. You know, the broker-dealer community has decided, you know, they don't want to take on that risk, and better safe than sorry, and so a lot of stuff just gets shut down.
Yes, and yes, sorry.
Yeah, well, I haven't seen that often with NASDAQ or NYSE MKT companies, but it's more
Mostly OTC.
right. Yeah,
It is, and the SEC has a very aggressive anti-microcap fraud agenda, and it's laudable. This is a very good thing, but unfortunately, this is one of the repercussions of it. And you know, as a transfer agent, that's a question we actually field daily. So, so I think there's two things that I tell depending on who I'm talking to. If I'm talking to an issuer, corporate governance is actually extraordinarily important, because if you have an independent board and you're doing your annual meetings and you're doing all things right, a broker is much more likely to feel comfortable accepting your security. If you're a shareholder and you have a certificate and it's difficult, we've actually interviewed all of the major clearing firms and broker dealers, and we've consolidated a list of their due diligence process. And if you're going to make an investment in a microcap security, these are the things you should be doing from day one, like before you actually give them them the check and make the investment, so that when you do go to deposit the shares, you can do so easily and hopefully painlessly. So if anybody is interested in that resource, I'd certainly be happy to share it afterwards.
It's also one of the reasons we require QB companies to disclose on a real-time basis their share outstanding number.
Yeah, absolutely.
You know, there was a huge issue with companies, even SEC-registered companies, that would put a shares outstanding number, and then they would run a printing press, you know, the next day, right? They're just diluting
Yes.
out of the thing. So, you know, trying to put those types of standards and requirements in place will hopefully help in that comfort level.
And the exchanges have requirements too, that when your number of shares outstanding changes by 5%, you have to file a form with them to notify them, because they're very interested in keeping up with that. On the anti-fraud thing, that really plays into the initial listing process, because one of the things that both exchanges do is they run all the officers, directors, and 10% or greater shareholders of the applicant through FINRA and the SEC, and they're looking obviously for adjudicated matters, but they're also looking for matters that haven't yet been adjudicated. There could be investigations, and you get someone flagged, and the exchange the exchange won't tell you what the problem is. They'll just tell you that you have a problem and that they're not moving forward with the listing application, and you've got to find a way to work through that and work around that.
And we have 60 seconds, so.
That actually led into my question, which is, when you find out that you've got a so-called bad actor, whether it's the auditor, whether it's an investor, shareholder, how long does it take to scrub the company at that point to be able to move forward?
Excellent question. So if you have a bad actor on your team, how long does it take to scrub the company clean of that? Great question.
Yeah. Well, it's usually not going to be the auditor, because the auditor has to be PCAOB, so you don't have to worry about that. But you know, it's really case by case. I mean, and there are some situations where you can go into the exchange and you can say, look, you know, we've proposed this, you know, this particular structure to try to neutralize this guy and separate him from the company and really impede his ability to have any influence over the company. And then you've got to get the exchange to buy into that. So they used to use things like voting trust fairly regularly. They don't really like to do that anymore. So you have to craft a specific solution for each case. And we spend a lot of time working with companies to deal with issues like that.
Thank you.
Specifically, let's say it is an auditor, since I've got a client, I think 3 clients right now, potential clients that are the same auditor.
Yeah, well, I think if it's an auditor, you just have to go and get a
Change
new auditor
auditors.
and have them complete their audit, and then you should be fine and be away from the old auditor. So now you may have to, the new auditor might have to go back and re-audit, some of the prior periods. We just had that this summer. We had a company, and the old auditor, was an issue. The old auditor didn't want to sign, even though the new auditor issued an audit opinion. So we ended up having to have the new auditor go back and reissue the year prior audit opinion. But yeah, it's there's no, when you have a bad guy associated with the company, there's no standard penalty. They don't say 1 year, or if you get delisted, they don't say you're off for 365 days and then you come back. And it's really case by case. I mean, they look at all the facts and circumstances and make their decision.
Very good. Well, I want to thank you guys so much. I'm so sorry we don't have time for all the questions, but perhaps you can snag us during lunch.
Great, yes, grab
Yeah.
some lunch, definitely.
Okay, I don't want to stand between you and your lunch, so I'm going to stop talking. Thank you.